Hello everyone, this is our lecture in chapter 16, which is going to be about capital structure. So most of you would remember that we kept mentioning that capital structure is irrelevant for cost of capital. So actually in this chapter we're going to revisit that notion and kind of deduct some insight from the previous chapter in which we highlighted sources of market inefficiency and relate those sources to market frictions that are going to give rise to situations where capital structure actually does matter. We're going to see different views of capital structure, and each view is going to have certain implications about how capital structure would or would not matter. And under each circumstance, a corporation is going to prefer certain capital structures over other capital structures. So I'm actually going to basically skip the principal learning objective part and jump into the actual material. So in chapter 8, we argued that capital structure was irrelevant. In essence, the capital structure was a pure risk-return trade-off from a perspective of equity holders. So remember that as we increased the financial leverage, what would happen was that the risk of future cash flows that were going to equity holders would become more risky. As a result, the required rate of return on equity would increase, which would just impact the equity prices, and that was all. It didn't have any impact on the cost of capital. Cost of capital was purely reflecting the technical aspects of projects or risky assets that the firm owned, and in essence was calculated using a CAPM, and that was it. Nonetheless, the operating leverage would still matter there, but that had nothing to do with the financial structure. Financial leverage, as a result, had no impact on cost of capital. So let's begin our analysis by just showing a simple firm and then try to change things and see how resulting characteristics of a firm is going to be impacted by differences in capital structure. So I'm going to focus on this Mediforms Incorporation, MFI. Let's suppose that it's fully financed by equity. Okay. In other words, it's unlevered, meaning that there's no leverage here. The expected annual cash flow on the firm is $300 per share with a minimum of $100. So this example should actually be familiar. We have seen the exact same settings before. Assuming that shareholders require a 15% rate of return, we want to calculate the value of the firm, the value of its equity, and the cost of capital. So the expected annual cash flows to the shareholders $300. They require 15% required rate of return, which means that we were looking at a perpetuity that pays $300 forever, meaning that the value of the firm or the equity of the firm is going to be $2,000, right? Because of the accounting equivalence with no debt, this $2,000 is exactly the value of assets as well, right? So 15% as a result is going to be the weighted average cost of capital in absence of any debt. Right, so equity is the only source of financing, so the cost of equity is going to be exactly the cost of capital. All right. Now, let's suppose that MFI sells $1,000 of debt at 10% rate, and whatever they raise is going to be paid as cash to shareholders. So basically, shareholders are going to receive $1,000 of cash. In return, their claim to the assets of the firm is going down by $1,000. So the wealth of shareholders is going to be a $1,000 of cash plus the worth of equity that they own from that firm. Right. So that's the situation. Now, under this situation, we'd like to calculate the value of equity, shareholders' wealth, leverage ratio, and the cost of capital. The total firm value must be equal to the value of debt plus value of equity. Right? That's just, look at whatever the market value of debt is, whatever market value of equity is, that must be the total firm value. Or in essence, the total value of assets in the firm. So we're thinking in accounting equivalence sort of setting here. So the equity is going to be $2,000. That's the exact value we had before levering the firm. Now we have $1,000 pay back to the equity holders, which means that their claims to the firm, the remaining claims to the firm's asset is only $1,000. Okay, which means that the market value of equity must be $1,000. All right. Prior to capital structure, we had the equity of $2,000. Right, that's basically explaining it. Right. So after the change, equity worth is going to be $1,000 because $1,000 of cash is going to shareholders, meaning that the wealth of shareholders is actually in change. It's still $2,000. It's now broken down into cash and equity. Beforehand, it used to be equity only. Okay, so if you want to look at the firm's capital structure now, we have divided capital. The financing of the firm into $1,000 of debt plus $1,000 of equity. Beforehand, it was only $2,000 of equity. All right. Well, let's do some beautiful stuff. Okay. So the annual interest rate or interest expense is going to be $100 because it's basically 10% of the $1,000 debt, right? The annual expected cash flow to the shareholders as a result is going to be $1,200. That's the remaining expected cash flow to shareholders. So here comes to play the information we provided in terms of the minimum cash flow is $100, which basically is making the cash flow to equity holders risk-free in form of default risk. So there's no default risk here. To debt holders, and debt holders would definitely receive what they expect to receive in terms of rewards of providing debt. Okay. Now, because equity is $1,000 worth, in order for having this payment of expected payment of $1,200 per year have a present value of $1,000, you would need to have a required return of 20%. So that's a RE in the case of a levered firm. Okay, which basically says that the cash flow to shareholders are becoming more risky because the sum of the cash flow is for sure taken away to meet financial obligations. We know that sort of stuff from before. All right. The leverage is going to be the market value of debt over market value of the firm, or debt plus equity, which is going to be 50%. And as a result, we can actually calculate the weighted average cost of capital. So with 20% cost of equity and 10% cost of debt, 15% weighted average cost of capital is what we find, which is exactly the same as it was beforehand, right? So the weighted average cost of capital does not really change as a result of change in financial structure. So in essence, we're back to our very insight that in perfect markets, capital structure is irrelevant for weighted average cost of capital. Okay, now let's see how imperfections could actually matter here and why firms would care about imperfections. So here I'm going to provide a hypothetical case where there is an arbitrage opportunity, and then show that under arbitrage opportunity, capital structure would actually matter in certain investments or investment decisions are going to lead to positive net present value without demanding any investment out of the investor's pocket, which is basically what we need in order to have an arbitrage opportunity. Okay. So if the firm value varies with leverage, okay, there is going to be arbitrage possibility. So that's the main point we're going to make. And we also know that in perfect capital market, arbitrage opportunities cannot exist. Okay, and whatever profits out of arbitrage can be must be eliminated immediately, making the capital structure irrelevant. Okay, so to make this point, I'm going to consider firm U that is identical to MFI before the change in its capital structure. So basically, U is going to represent MFI version or the unlevered version of MFI. And then we have firm L, which is identical to the levered version of MFI. Okay. However, here we're going to make the assumption that firm L's equity is valued 1,500 instead of $1,000. All right. We'll recall that the MFI equity used to be valued at $1,000 when the financial structure changed. Okay. This means that the total value of firm L is going to be 2,500. In essence, it's 1,500 plus the 1,000 debt. Okay. Now let's think about how this could lead to an arbitrage. Now, suppose you own 10% of firm L's equity, okay, the levered firm, which means that if you own a certain number of shares, your share worth could be something like $150. Right? So at 10% of shares, your share is going to be worth $150. $150. So it's basically 10% times 1,500 total equity value of the firm. Okay, you're entitled to 10% of L's cash flow as a result, right? Which means that you're going to get 10% of the $200, $20 per year of cash flow. Okay, now let's say you sell your shares of firm L. Okay, which means that if you do, you're going to make $150, right? That's what you make by selling this. And then you're going to buy, you're going to borrow another $150 at 10%. So in perfect capital markets, you always can raise capital at that 10% rate. Then it means that you have $300 in cash, right? 150. The money you make by selling the stocks that you have, and 150 by borrowing at 10% rate. Okay, so this means that you have a personal leverage ratio of 50%, right? 150 borrowed, 150 owned. All right. Now I'm going to use this $3,100 to buy firm U's stock, the unlevered firm. Okay, if I did. It means that I own 15% of the $2,000 worth of firm U's equity, right? So that's 300 divided by 2,000. Sorry, 300 divided by 2,000, which means that I'm entitled to 15% of firm U's cash flow. The firm U's cash flow is $300 per year. 15% of that is going to be $45. Okay, so $45, the pure amount I make on an annual basis, or I expect to make on an annual basis. Now, what is the magnitude I must pay in order to fulfill my financial obligations, right? Recall that I've raised $150 of debt. There's 10% return on that, and I must pay $15. Okay, so if I deduct the $15 of interest off of my $45 that I expect to make annually, my new cash flow is going to be $30. Beforehand, when I owned 15% of the levered firm, my cash flow was 20. Okay, so here I'm basically doing nothing except doing arbitrage, right? I'm borrowing a little money and I'm cashing out of firm L and put the resulting amounts, investing the resulting amount in firm L, and I make this additional $10, right? So this is a pure arbitrage situation, okay? But this arbitrage situation wouldn't exist had firm U's equity been valued at $1,000. All right, so this is just a simple explanation of how this arbitrage opportunity should not exist in perfect capital markets, right? And recall that the perfect capital market assumption is embedded here. You're able to borrow at 10%, like the firm is able to borrow at 10%. So the fact that the rate of interest is equal for you versus the firm is the reason why we have perfect capital markets here. Okay. All right. Okay, my dog is barking. Quiet. So we're going to look at corporate income tax view of capital market structure here. So here we're going to say, well, there is a tax asymmetry here, and that is the interest payments that are made by corporations are tax deductible. But if the corporations pay dividends, those dividends are not tax deductible. So from the firm's perspective, it's cheaper to raise debt. So that's the intuition. It's cheaper to raise debt because for every dollar that you pay for debt interest, there is some tax credit that you're entitled for. But if you pay money to equity holders in terms of dividends, which are in essence the payments for for equity financing, you're not entitled to any tax credit. So that's the idea. Okay. Now, because of this tax asymmetry, there's going to be some sort of advantage to financing a firm by debt only, and that's one view of capital structure that leads to certain conclusions about relevance of capital structure. So to give you an example of that, let's go back to our MFI firm. Before it was levered, suppose that the corporate tax income was 40%. Well, now we want to compute the value of the equity and total firm value given this tax rate. So recall beforehand we had no tax. So here we have government coming in wanting to collect some tax. So the after corporate income tax cash flow is going to be 300 times 1 minus 40. So we have seen this in our cash flow chapters, right? So whenever there is an inflow for the project, that inflow must be after tax. So the after tax inflow is going to be 180 now. And assuming that the 15% required of return is still there, the firm value for the unlevered version of MFI is going to be $1,200 in presence of taxes, which means that $800 of the $2,000 value we used to have without government is now being collected by the government in form of tax. Okay. Now suppose that MFI sells that $1,000 of debt at a 10% rate, okay, and pays the proceeds to the shareholders, okay. So let's see what the total firm value, equity wealth of WACC, so on and so forth, is going to be. The annual interest expense is $100, okay. Now, the after corporate tax cash flow to shareholders is going to be now $200 times 1 minus 40%. So recall, so see, it's really important to notice that the $100 here is not being taxed at all. So we're going to apply the tax after deduction of the $100 interest payment, which implicitly means that the $100 interest payment is tax deductible. All right. So $120 is going to be the amount that equity holders expect to receive on an annual basis. Now, if, like before, as a result of this leverage, increase in leverage, required return goes up to 20%, then the value of equity is going to be 120 divided by 0.2, $600, which means that the firm value is going to be $1,000 of debt plus $600 of equity on $1,600. So the wealth of the shareholders as a result is going to increase from $1,200 from the previous case, the unlevered but taxable firm to $1,600 after raising the leverage. And the incremental increase in shareholders' wealth is due to the corporate tax and the fact that, or the assumption that debt is not taxable. So now if I were to basically have similar charts to before, what I have in unlevered firm is something like this, where $800 of firm value is captured by the government. But now after issuing debt, see, the whole debt is not affected by tax. It's $1,000 as it was before, but the equity component is now going to be taxed at a 40% rate, which means that $400 out of $1,000 of equity is going to be captured by the government, leaving equity holders $600. Okay, so this means that the firm value here is going to be whatever is not captured by the government, which is $1,600, whereas in the unlevered situation, whatever is not captured by the government is only $1,200. Okay, so the firm value is higher when there is tax asymmetry with regards to equity versus debt. Okay, so let's actually try to understand what this says. It basically says that there is some gain due to this tax asymmetry. Okay, basically the unlevered firm pays this much per year in taxes, right? So whatever you make is going to be subject to tax if you're unlevered. But if you're levered, only 200. The after interest revenue is going to be taxed. So there's a difference between this of $40. Okay, now that $40 is basically all debt related. Now the opportunity cost of debt or raising debt is 10% per year. You're saving money, you're saving $40 due to debt, so you have to apply that same opportunity cost to calculate the present value. And once you calculate the present value of these tax savings, the difference between 120 and 80, you exactly find the $400. So going back here, that's exactly what we have. The present value of tax savings is what we now have. So like the difference basically between the $800 and $400 before and after leverage. Okay? So as a way of formalizing this, the value of the levered firm is always equal to the value of the unlevered firm plus T times D, where T is the tax rate and D is the total amount of debt. All right? So to get to the leverage ratio, now the market value of debt is $1,000, but the total firm value, or the addition of equity plus debt value, is $1,600, leaving us with a 62% of debt. All right, so it's not 50% anymore. That's important. So you're actually going beyond 50% by issuing $1,000 of debt. Okay. So that said, we're going to have a different setting when it comes to calculating weighted average cost of capital, right? So with required return on equity of 10% and debt interest of 20% and debt interest of 10%. Now applying applying the new leverage ratio as well as the tax credit on debt, okay, we're going to end up with a weighted average cost of capital of 11.25. This is much lower than the 15%, right? So without tax, it used to be 15%. Now, because of tax, there are two changes. One, the leverage ratio is larger than what it was before, because effectively part of the firm value is captured by the government, and as a result, because the market value of debt is constant, it means that in the leverage ratio, the numerator is unchanged, still 1,000, but the denominator is changing because the government is taking away value from equity holders. The value of equity is going down by $400 from 1,000 to 1,600. Okay. We also have this tax shield working here. Okay. Meaning that the effective cost of capital after tax is less than the nominal cost, which is 10%. Okay, so 10% is multiplied by 1 minus t to give us the effective cost of capital, which basically includes some tax deductions due to interest payments. Okay, so the message here is that the cost of capital is actually lower than what it was in absence of any corporate tax. So you could have a different view of this levered firm's value. You can say, well, I can now use this weighted average cost of capital to discount the perpetuity of expected future cash flows that go to equity holders and calculate the value of the firm, which is a fair thing to do. So after tax cash flows are $200, but you're going to discount those with weighted average cost of capital. And if you did, you would calculate the value of the levered firm. So note that this is debt plus equity value. All right, it's not just equity. So this is important to notice. So when you discount the expected future cash flows to equity holders using weighted average cost of capital, you're calculating the value of the firm. That's very important. It's not value of equity. If you were to do value of equity, you would have to discount by RE, the required return on equity. So the result is that with this setting, as you increase leverage, what's going to happen is that with the weighted average cost of capital is going to go down. The more debt you have, the greater the benefits from tax credits due to interest payments to debt holders, and as a result, the lower the cost of capital. So that's the basic idea. All right. So in order to actually formalize that, we're going to exploit some of the formulas that we have used before. So remember this one and this one from before. So the value of the firm, the levered firm, is value of equity, right, plus the value of debt. And the other formula that we have was the present value of cash flows at discount rate equal to weighted average cost of capital. So what I'm going to do is that I'm going to set this equal to this, and then if I solve for weighted average cost of capital, I find a formula like this. Okay, so what this formula says is that leverage goes up, then WACC goes down. Agree? Because leverage has a negative sign here. I'm hoping that's clear. And that's exactly why we see this pattern here. Leverage goes up like this, and the cost of capital is going down. All right? So, to summarize the corporate tax view, we have basically four main formulas: the value of the unlevered firm, the value of the levered firm, so in presence of tax, this is what you get if you're unlevered, but if you lever the firm, you will enjoy the present value of tax savings. In essence, for every dollar of debt, you're going to be subject to T dollars of tax credits, right? Now, the interest payment, however, is RE. Okay, so this is basically the amount of actual tax savings that you receive. You're going to discount that with RE, so RE and RE are going to cancel out, and then the present value of tax savings is only going to be T times D. Okay, now we also have this formula, right? The value of the levered firm is simply the present value of the after-tax cash flows at the rate of weighted average cost of capital, right? So notice the difference, right? The unlevered firm uses the required return on equity, but this is RD, by the way. Sorry, guys. This is RD. But here I'm using the weighted average cost of capital. And then finally, we combine these two formulas to calculate the weighted average cost of capital as a function of return on equity and leverage. Okay, so RE goes up, W's weighted average cost of capital goes up, L goes up, weighted average cost of capital goes down. That's the idea. All right, so in the next video, I'll be talking about the personal tax view, and then we're going to finish the lecture for today.